Hello, and welcome to Virtual Investor Conferences. My name is Cecilia, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Private Bancorp of America, the holding company for Cal Private Bank. Please note you can submit questions in the box to the left of the slides. You can also view the company's availability for one-on-one meetings through the Scheduled Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Rick Sowers, President and CEO, and Corey Stewart, EVP and CFO of Private Bancorp of America, which trades on the OTCQX Best Market under the symbol PBAM. Welcome, Rick and Corey.
Thank you very much, Cecilia, and thanks for having us. Good afternoon or good morning, depending on where you are. We'll just run through our presentation here, starting with, of course, the forward-looking statements that we may make comments during this meeting that are forward-looking. So please peruse that forward-looking disclosure at your leisure. For those of you who are not familiar with our company, Cal Private Bank is located and headquartered in La Jolla, California, with 6 offices throughout Southern California, Los Angeles, Orange, and San Diego counties. And primarily the company is a branch-light, high-touch model, which really affords us to connect with our customers and provide them with superior service. And we'll go through some of the things that we think distinguish our company over some of our peers. You can see there are relative stock performance. Obviously, we've not been immune from what's been happening with the rest of banks, specifically community and regional banks, throughout this 2023 year. But I'll tell you a little bit more about the company, and please, if you've got questions, in the Q&A box. So our first quarter highlights here, we had income of almost $9 million. That was record earnings coming off a prior quarter of record earnings. That was $1.57 in earnings per tangible diluted share. We reached $2 billion in assets with $1.6 billion in loans held for investment and $1.6 billion in deposits. So a tangible book value of $26.30. And I would note that we followed up the quarter with a press release about a recovery of a charged-off loan that we made in 2018. That was recovered, and that added about 94 cents in tangible book value. For more information, that certainly is available on our investor site or via Newswire. Asset quality, we have a ALLL totaling about $21.1 million, or 1.3% of total loans held for investment. No delinquent loans, no charge-offs, and no doubtful credits. So loan book performing very, very well. From an operational highlights perspective, our efficiency ratio is just shy of 49%. We're very, very proud of our net interest margin, which is 4.90%. This is in the top 10 to 15% of banks in our asset class, and we produced a 25% return on tangible common equity in the quarter. Loans and deposits highlights, our company has historically been a fast grower, so 25 to 30% compounded annual growth rate over the last 5 years. This last quarter, we obviously saw slower growth with what was going on in the economy. Loans held for investment grew 2.2%. Our core deposits declined slightly, which was primarily seasonal and not related to the March madness that we saw relative to the banking sector. Total cost of funds was all funding at 1.39 and total cost of deposits at 1.23. Also, I think important to note, for a $2 billion company, we've got $1.4 billion in total liquidity available at the end of the quarter, and that represents 173% of uninsured deposits. So what are we focused on? So primarily opportunistic growth. And I think we say opportunistic growth because this is a market where demand for loans is down sharply across the industry, and we're seeing the same things here. So we're opportunistic. We're very, very concerned with yield and maintaining our net interest margin, which ultimately is based on our high level of profitability expectations for our customers, for our company, and how we price loans. So relative to the market, we're never trying to be the cheapest loan. We're trying to be the most creative, and we're very execution oriented. Additionally, our SBA business, we're a preferred lender, but primarily real estate based 7A and 504s. But we really focus in on the core banking side of our business on, real estate investors, high net worth individuals, family offices, and professionals. The non-interest income for this year, you'll see, was down year over year. This is really a focus of our company in 23, expanding our non-interest income through increases in treasury management services, merchant services. We do have a fairly robust book of international business based on where we're located in San Diego. Lots of high net worth families that are cross-border families that we serve from a private banking perspective. And I think another differentiator for us is we really spend a lot of time and energy, and specifically have a board level committee that is committed to innovation. And we really look at innovation in a couple of different ways. Number one, how do we serve today's customers better and prepare ourselves for the next generation of our clients that are much more tech forward, and also leveraging technology to lower our overall cost. In terms of asset yields and cost of funds, we went over cost of funds, but asset yields, you can see there, are in the mid to high sixes. And you will see we've been growing that. About 30% of our book is floating. That's allowed us, as the Federal Reserve continues to move up the curve in terms of interest rates, we've been moving up with them in terms of our loan yields. And you'll see there, maintaining our net interest margin in the high fours is a source of pride. So strong loan yields, deposit retention has been consistent and growing. And we are, of course, really focused on how do we maximize profitability in this volatile environment. Corey, why don't you talk about our deposit franchise?
Sure, yeah. As Rick mentioned, protecting the margin of the company is hugely important. And on the funding and deposit side of the house, we try to maintain a very strong core deposit portfolio. You can see that the non-interest bearing deposits are approximately 40% of total deposits. As far as balance sheet growth, we do find ourselves at a time where the loan to deposit ratio is approximately 1 or 100% right now. And so if you think about it, one of the constraints that we have for growth is deposits. And so first and foremost, the priority for us is growing deposits, non-interest bearing and core being the primary focus. Beyond that, we do have exception pricing. And what I mean by that is we're not just like moving our rate sheet up as the Fed increases rates. Rather, what we're doing is working with customers one-on-one to make sure that we meet their needs and also, manage and protect our NIM at the same time and the cost of those deposits. We do use brokered deposits and Federal Home Loan Bank advances as alternate sources of funding. And really that's kind of pricing driven. So at the end of the quarter, we did utilize more home loan bank advances than we had previously. And that was really just driven by pricing, as the pricing was more advantageous than the brokered deposit or the brokered CD market. Moving on to the next slide, Rick. Here, Rick mentioned that we have about $1.4 billion of total available liquidity as of last quarter end. And with, I like his term, March Madness, actually, that's a good one. That's one of the things we focused on from about March 9th forward, is really making sure that we've got very strong loan and securities pledging in place, alternate sources of contingent funding. Another focal point was looking at our uninsured deposits. I'm sure that everybody's heard that in the headlines in the last couple of months. Our uninsured deposits stand at about 50% of total deposits, which incidentally is about the industry average. But if you think about our business model, which caters to high net worth individuals and business owners, I feel like, that's actually relatively a strong position for a company such as ours. Moving on, Rick, let's turn it over to you to talk about loan originations and the loan portfolio.
Yeah, thanks, Corey. And as you can see here on this slide that's available in front of you, number 9, our loan yields for new loans on average coming in at 773 during the quarter, up from 735 in the prior quarter. But you'll also note that originations are down. As we've mentioned before, demand from a customer perspective is certainly down. We see a lot of customers kind of playing the sit and wait game, and I think given the fact that borrowing costs are just that much more expensive, there are less things that are going to pencil out for our customers. So we expect that originations to continue to be at a depressed level relative to our historical for the balance of the year. We don't think that's necessarily a bad thing for based on what's going on in the industry and the potential recession. Looking at our overall portfolio, 26% year over year growth in the loan portfolio. And it's fairly granular in terms of if we look at non-owner occupied versus owner occupied. And like most California community banks, we're primarily a real estate lender. About 70% of what we do is real estate related. And then the balance of it is really that C&I type of business and lines of credit to our wealthy clients. Moving on to the portfolio breakdown by industry, again noting heavily in the real estate industry, but I think some important things to note. So our overall portfolio, in terms of the real estate portfolio, is an average LTV of about 54%. Also has a debt service coverage ratio of over 1.5. And the primary makeup of that from a geography perspective is Los Angeles, San Diego, and Orange County. So, we're playing in the markets that we know. And of note, the things that are getting everyone's attention right now are really office, motel, hotel, and retail. You can see those totals over there. And I'll just touch on the office one because this tends to be a question on the office side. And really our office, about 55% of that is actually owner-occupied real estate. So it's an owner-occupied office. This is where one of our clients owns their own building and we finance their own building. So this isn't where our clients are looking for, trying to find tenants. And I would also note that the primary, the large preponderance of our portfolio is coastal Southern California. So this is not in downtown areas. We don't have any large office high rises. This is primarily, 2 to 4 kind of unit coastal real estate that is, low LTV. Like we like to keep an eye on our utilization of lines of credit. This is one thing we like to see, utilization up near that 60% level. It still has historically been below that. We have seen some migration of people taking money out of their checking accounts with us and savings accounts with us and paying down their lines of credit. So, obviously as borrowing costs continue to get higher, there's this notion that if people have excess cash, they're either investing that cash or they're putting those excess dollars towards paying down their lines of credit and loans with us. So we expect utilization to continue about these levels. Again, we like to see that 60% is kind of the marker, which means we don't have excess unused earnings out there, or unused lines out there. But this current level is kind of what we're expecting going forward. And I think Corey, there are some questions over here. Crypto and startup was the first question, is what's our exposure in that? We have zero crypto. We don't do startup lending. We're not into the venture capital side of things at all in our company. We're primarily right down the fairway in terms of family office professionals, real estate professionals. Corey, you want to read the other questions there and we'll take a pause for some Q&A?
Yeah, let's do that. The first question that came in was, can you discuss how you're using technology to lower your cost of funds and stay competitive? One of the things I was really impressed with as far as the funding side of the house was when the March Madness hit, over the course of a single weekend, we stood up the ICS products, which I don't know if you've heard of Cedars. They also offer a money market product, but the ICS products are a very nice way of offering deposit insurance to customers of ours that have very significant balances. And we stood that up over the weekend and were operational even by Sunday, honestly, but then moving into that first week. And Rick, would you have anything else to say on the comment of technology and deposits?
Yeah, so, and I think it's important to note that one of the initiatives we have this year is to build out a customized deposit origination system. So we've chosen a technology, a fintech partner in order to do that. You know, retail deposit account opening has been around for several years, but there are very few that have mastered kind of commercial and very complex deposit account types. And we're certainly very, very focused in on that, as well as are the loan origination side. So, you know, two sides to our company in terms of how we're putting our non-interest expense dollars towards technology. One on making lending easier. We implemented the nCino platform last year, and we're currently working on a project to completely overhaul our commercial account origination. And then the second question here was, how are you mitigating interest rate risk while depositors are requesting higher yields with lower yielding loans? And I'd say the first thing is that our loans are not low yielding. So if we look at a comparison, for example, of those companies that failed, First Republic as a good example, you know, their net interest margin was approaching 2%. Ours is almost 5%. You saw our originations in Q1 reach 773 in terms of the yield. We're really aware of where we originate loans and keeping our cost of deposits as low as possible, such that that profitability continues to build for our shareholders. Just, you know, looking at some of the market dynamics, you know, one of the things we've been very successful in is the SBA business. So, of course, on the 504 side, this is a 50% first trust deed, loan. Those right now, just to give you a flavor on yields of those are somewhere between 7.5% and 8.5% is where we're doing those credits today. And of course, the 7A business has really suffered. There are very few customers out there that are looking for variable rate loans that are real estate backed, considering those probably are 10 to 11% yields right now in terms of those coupons. So, you know, we've seen lower overall demand for 7A loans, and therefore the resulting gain on sale has been lower. And we expect that's going to continue to be depressed through the balance of 23. Corey, why don't you take interest rate risk here?
Yeah. Just speaking of interest rate risk, and I guess at the highest level, we're slightly asset sensitive right now. So in general, if you think about it, if the Fed raises rates, our net interest income benefits in the short term as a result of that. You know, the yield on our assets goes up and sort of outpaces the cost of funding and such. But with that said, you know, we're proactively managing interest rate risk, and the focus lately has been on the possibility of declining rates, right? So we're putting in floors into our loan contracts and things of that nature. And, you know, given the slight asset sensitivity, you know, we need to make sure that we mitigate the risk, the downside risk there. The other thing I would mention, and Rick alluded to this earlier, our investment securities portfolio is relatively small. It's only about 6% of assets. And some of the other banks that ran into issues, it was due to the size of their investment portfolios and the mix and the nature of the investment portfolios. But in our case, the interest rate risk that's introduced by the securities book is relatively small. You'll notice in the upper left of this slide a breakdown of our loan portfolio, and only about a third of our loans are fixed rate loans. The other 2/3 are hybrid or adjustable rate loans. And one of the things that we're spending a lot of time on right now is, you know, putting in place or monitoring a 12-month dashboard so that we've got visibility into the loans that are either maturing or repricing in the next year, so that we can work proactively with clients well in advance of that event occurring. And that's one of the things that we're doing, again, to help manage our margin.
Thanks for that, Corey. So on the credit side, as I mentioned at the beginning of this, a very low level of non-performing loans to total loans, 0.27%. We've got, the detail here. So no past due loans at all. One commercial real estate loan that's 48% LTV. Two loans that are 75% guaranteed by the SBA, and one loan with a 90% guarantee. So we feel pretty good about the credit metrics right now, and how those are performing. And part of that just goes back to our model, right? When you really know your customers, and you spend a lot of time with your customers and being proactive with your customers, typically you can get in front of credit issues. And as Corey mentioned, we've got this 12-month dashboard that we're really looking through, not only what's happening with our customers and where they're feeling stressed, but what happens if rates continue to rise, and what will things like debt service coverage ratios and LTVs based on cap rates at origination, how will that look moving forward? Just some more information here on classified and criticized loans that we just went over. CECL, we adopted CECL. Corey, maybe you could just give some commentary on that.
Yeah, the current expected credit loss model, we adopted that new guidance on January 1 of 2023. And, it resulted in about a 10% increase to our overall reserve. And I guess I would say management feels very good about the reserve that we have in place, and that it's sufficient to cover the lifetime expected losses in the portfolio. We have a very strong partnership between the credit department and the finance department, as far as running our CECL model, monitoring that, putting together disclosures, speaking to investors and whatnot. And if you follow us at all, then you would have noticed in a press release earlier that we did have a loan recovery this quarter. I think Rick alluded to it earlier, to the tune of about $7 million. And so that will benefit our income statement this quarter. As far as operating expenses go, we've provided a graph here that shows the 5-quarter history. But we're, needless to say, with sort of the never always looming recession that we're still waiting for, we're managing expenses very closely. With the high levels of inflation, like all other companies out there, it has definitely put pressure on compensation costs. And so we've been doing our best to manage those as well. The efficiency ratio, incidentally, you'll see that has trended down over the last handful of quarters. And that's really largely a consequence of operating leverage. We've had the benefit of our revenues increasing at a greater rate than our expenses. But part of that is the expense management that Rick and I are very focused on. At the same time, we are positioning the company for the potential IPO or a potential IPO in the future. And so while certain costs we think are going to be lower than they have been in recent past, for example, legal expenses, we had the one loan recovery that we spoke of that has been in the works for many years, and there was litigation related to that. And so legal expenses were elevated. We expect that to be at a much lower level. But with us preparing the company for a potential IPO, certain other expenses will increase as we put key personnel in place, as we look to implement enhanced processes and controls that will eventually be required under SOX and things of that nature.
Yeah, and I would just note that assets per FTE, which is one of the things that we measure pretty consistently, continues to rise. Which in a high touch, high service model is not always the case, but we're really focused in on how do we get more efficiencies in the loan portfolio. Strong capital position. You'll see what our capital ratios here at quarter end, and of course those will adjust upward based on that recovery that we've mentioned. There was a question in the Q&A about dividends. We do not currently have a dividend in place, and the strategy there has been build tangible book value, build capital, because we've been so growth oriented that we've been able to efficiently use that capital to preserve and provide good returns to shareholders. So that's the question on the dividend side. One of the things that we're very, very proud of and that we use to differentiate our company is what we call our distinctly different service. And, there's a lot of companies, especially community banks, that talk about, their service model. And I think, there are very few of us who measure it, and we measure it consistently. So, if you're familiar with the Net Promoter Score, this basically looks at, are your customers willing to be referral sources for you, and would they refer their friends and family? So we have a Net Promoter Score of an 84. This is down 1 point from an 85 in 2021. This really is something that we track very very closely. Management is compensated based on both this measure as well as our own employee satisfaction, which is the Employee Net Promoter Score. And we're 2.5 times the industry average. And this is something that, we're proud of. This is how we run our company. Is it all starts with how we treat our people, how we treat our clients, and therefore that produces superior results for our shareholders. Another big part of our kind of company culture is giving back into the communities that we serve. So we give a lot of hours back to charities, and lots of our employees are on boards of directors for nonprofits that are in each of the communities, and we give a substantial portion of our time and treasury back to those companies. I think it's also important to note that we are really focused in on the diversity of our company. And the diversity, we think, provides our team, our board, with alternative, different, and full points of view that help us make the best decisions. So we are really focused in on this as a company and what it provides for our shareholders. Just as a recap on some of the things we've been talking about as we are moving down in time here on the technology and innovation perspective, we mentioned that we have a technology level board committee. We actually just are in the process of bringing on some new employees. Corey mentioned key hires this year that are really in product strategy and innovation. We have made direct investments in 3 different fintech companies. Although these have been small, this really allows us to be in the ecosystem of technology partnerships that we believe are going to be important for things like payments, things that are going to make us more efficient in the next few years. So this is something we're really focused in on as well. There was a question over here. Yeah, go ahead.
Yeah, we'd have another question come in. What are your growth drivers for the next 12 months and any expansion plans? And Rick will provide details, but the recent shakeup in the banking industry has provided potential opportunities for hiring strong teams of producers or individual producers. And I know that Rick is spending a lot of his time scouting for folks like that and meeting with folks that might be a good fit culturally for us.
Yeah, I think that's exactly right, Corey. So we view any kind of disintermediation in the marketplace as an opportunity for us to bring on new talent. We've hired an additional 4 relationship managers with a number of new relationship managers that are in the queue. Part of what we really look at when we're looking for teams of people is, do they fit culturally? We are very much a high growth company, and we don't believe in babysitting our people. So we hire people who are self-starters, who are really focused in on execution and understand our service model. And so that's kind of the way we look at hiring. In terms of geographic expansion, there are 25 million people between our northern branch and the Mexico border. We think there's lots of opportunity within our existing markets, particularly as some of the larger lenders are pulling back. So we think there's a pretty major opportunity there for us to pick up talent and new clients. And we've been demonstrating that over the last number of quarters. And that is it for us. So thanks very much for allowing us the opportunity to speak with you today. The calendar is available for one-on-one meetings. If you're interested, we're happy to oblige. Hopefully we've gotten to all the questions. Looks like we did get to all those questions. So thanks very much from Corey and myself and Cal Private Bank. We appreciate your time.